Welcome to our High Rock monthly video for August. I am Scott Tomlinson, and with me on the call today is our founder, managing partner, and portfolio manager, Paul Tepsich. We're going to chat a little bit about what happened in July and a little bit about what we're doing with our models and a little bit about what we see coming down the road. So stay tuned for a whole bunch of excitement. Well, let's talk a little bit about July. July was a significantly less volatile month. And as a result, we saw stock markets doing significantly better, led by US equity markets, followed by global equity markets. All of that helped pull the balanced benchmark higher by about 5% over the month. So you can look to see how your portfolio did relative to that. Bonds were better. Canadian equities were up. The only thing that wasn't really working, the gold silver was basically flat, and preferred shares were down on the month. And Paul, I'll let you make any comments that you have with regards to any of that.
Well, gold and silver haven't performed all that well through the last while with all the expectations on inflation. So to be honest, not entirely sure what's going on there, and we're certainly not adding to those positions. Maybe we should be. And preferred shares with interest rates on government bond yields coming down, and preferred shares, rate reset preferred shares at least were hit a little bit, but they still have and continue to perform quite well for us.
Excellent, excellent. Okay, and let's just talk about that balanced ETF that we monitor as our benchmark. And this is a comparison that you can use when you look at how your portfolio performed. And of course, we're here to have that conversation with you. We like to have something with which to gauge how our balance is working relative to a benchmark balance, and we find that this iShares ETF is something that we can look at and monitor ourselves against. But we're more than happy to have conversations with our balanced portfolio clients as to how each of your portfolios is performing relative to this situation. We think for the most part that we've been able to mitigate everybody's downside through the first half of the year, and things as we move forward, the fact that we've been mitigating the downside and using the downside to do some adding to some of our models have helped us bounce back, and maybe bounce back a little bit more quickly than other balanced mandates. So we're happy to have these conversations at any time. So just please feel free to get in touch. And as always, we want to be engaged with you as much as you want to engage with us.
And Scott, I would just pause on that slide too, if I could just mention that our high yield mandates, which we have about 9 or 10 clients in those mandates, have performed extremely well. I won't give out any specific numbers, but it doesn't have a minus sign in front of it. And a lot of that has been driven by our call in energy credit, energy bonds, as well as some cash that we're holding through the first half of the year. So if anyone wants to know more about that, please get in touch with me.
Yeah, absolutely. And for our balanced clients, know full well that if you have allocation to our tactical model, you've had some exposure to that high yield mandate, or some of the names that we have in our high yield mandate are also in that tactical model, right, Paul?
Yeah, for sure.
Okay, so
most everybody has exposure into the tactical model. It's a matter of how much percentage weight they have, I guess, given their investment policy statement.
Exactly, and that's also something that we want to have conversations about. If anybody wants to talk and update their strategies, we want to have those conversations with you as well. Great, thanks. That's great, Paul. Again, we're always focusing on the long-term and long-term goals, and everybody has different goals. So it's important to make sure that we're updating your strategy according to those goals. If your goals are changing, or if you want to revisit what we're looking at for you as far as your goals are concerned, and you want to revisit your asset allocation strategy, it's something that's very important to us to make sure that we're getting right. So, and that means that we need to have conversations. But, again, let us know. As we've talked about many times, we think that the expectations going forward should be managed accordingly. We saw very strong relative performances in the 12-year period from 2010 after the last recession. Certainly, we're going to see some. We're seeing now some downside as we head into another recession, and the question always is going to be, where are we with regards to that recession at this point in time, and what do we foresee coming with that? And we'll talk about that in, I think, a little bit in a second. But again, we want to make sure that everybody's expectations are well managed as to what we think will happen as far as balanced portfolios are concerned going forward, and how your particular portfolio fits into that scenario. In the global equity strategy, as I mentioned, we have been using equity markets sell-offs from time to time to dollar cost average into and utilize some of the cash that we've been sitting on to buy into equity markets. We've been doing that and getting some decent prices, some good value. As we always talk about, when value when equities are expensive, we're more likely to want to be selling and rebalancing to higher weightings of cash. And when we see equity prices come down back into value territory, we look at that as an opportunity to be doing some buying. So we have been adding equity to the equity model and reducing our cash position through the sell-off. Paul, do you want to add anything here?
Yeah, I mean, I'd probably say the same thing I said last month on the video, is that we're never going to find the bottom, and we're never going to buy 100% of what we want to buy at the bottom. So we're dollar cost averaging on various securities on the way down. I think, Scott, it's probably fair to say that we were pretty disciplined in some of our recent purchases over the past 6 or 8 weeks on big down days. We didn't chase those violent up days that we've had. So I think we just kind of continue with that MO. It's probably the best thing to do.
Yeah, and that's the strategy that we've utilized, and it does work for us, and it works for our clients as well. One of the things that we did see was that the U.S. is in what we will classify as a technical recession, which is GDP growth quarter to quarter negative for 2 quarters, and we'll see how that carries forward, and whether or not the economy in the United States continues to underperform, and that's something that is going to happen as higher interest rates take hold. It will slow economies. The expectation is that we'll start to bring inflationary pressures that we've been seeing down. We are seeing lower energy prices at the moment, but other things are happening in the economies. Retailer shelves are still holding high levels of inventory, which means that consumers are stepping back and not making purchases. And that's going to put some downward pressure on economic growth, not only in the U.S., but also in Canada and on a global scale. So we'll continue to monitor this, but at this juncture, our expectations are for a continued weakening in economic growth and for the foreseeable future, as long as the central banks are raising interest rates. Today, the Bank of England raised interest rates by 0.5%. It's expected that the Federal Reserve will raise again in September by about 0.5%. We're still expecting interest rates in Canada to go up, and I think that as long as we have those expectations, we can expect to see slower economic growth. But the flip side of that and the positive side is that should start to bring inflation back under control and allow the central banks to ease up on the brakes, as it were. Paul, any comment?
Scott, yeah, I do have a comment. We should probably add that, what are called high-powered rates, which are government bond yields, which all loans, mortgages, everything is based off government bond yields because that's where banks or lenders fund themselves off a spread over top of the government bond yield. And certainly in Canada, well, both in Canada and the US over the past month, when we talk about interest rates, it's certainly, you were just talking about them, we were focused more on the overnight rate that the central banks around the world can affect. But out the yield curve, as we saw in our return chart near the beginning of the slide deck, interest rates have actually gone down. So bond prices have gone up, and the return was stronger. So, well, there's the chart right there. 5-year Government of Canada bond yield. I mean, it's rallied, pretty much 100 basis points. And I haven't looked yet, but I did hear through my son, who's a real estate agent, that some lenders have already cut fixed rate mortgages 3 and 5 year. That's a very substantial move in rates from 360 down to basically 260. And certainly is, as of today, we're talking about close to it. So that's already starting to happen out the curve. And the reason why that is happening is because the government bond market is enormous in size, much larger than the equity market. It's institutionally traded. And what the bond market is telling us, and Scott, you and I have said many times, bonds lead capital markets, but it's basically telling us that yes, the economy is slowing dramatically. And for the first time ever, you've got the US Federal Reserve raising rates in the middle, overnight rates, that is, coming into a recession, and a lot of economic weakness on the horizon. So the bond market is basically saying the Fed's not going to be raising much longer, and we're going to have lower rates because we need them, because the economy is going to suffer. So we're already seeing a bit of a relief in government bond yields, which is transferring into other lending, like mortgages. And we'll keep an eye on that and see how that transfers into other lending. But that's an important factor in my mind.
Sure, but one thing to remember too is that a lot of household borrowers, a lot of household debt is based on a variable rate, and those variable rates are significantly higher and expected to continue to go a little bit higher. So you're seeing this separation from longer term interest rates and shorter term interest rates, but a lot of household debt is based on those variable rates. So the relief isn't necessarily going to be coming that quickly to the household sector. And I think that's going to have some implications for consumption habits and people postponing major purchases going forward. And we're already seeing that in the housing market, aren't we?
Yeah, for sure. I mean, we're seeing it everywhere. So yeah, there is the difference between the overnight rate from the central banks, which affects HELOCs and lines of credit and variable mortgage rates, versus fixed rate. So fixed rate out the yield curve, have already started to come down, but variable will not until the Fed and the Bank of Canada come out and at least pause and then finally cut rates once they realize we are in a recession. So I think my view is it's going to, we see another raise from the Fed in September, whether it's 50 or 75, I think is irrelevant. And then they pause. We've got midterm elections in November, and every signpost is going the other way. So I think they're going to blink and pause, blink on the inflation front.
And that brings up another point too, Paul, here is that, clients, if you have debt and you want to discuss whether or not you should be floating a in variable or if you should be fixing it for a longer term. Again, it's very individual in perspective, and it does pertain to your financial outlook going forward and your tolerance for fluctuations in your cash flows and things like that. So we're always here and want to be able to have these conversations with you as well. If you have debt and you want to understand what the implications are going forward. Paul, anything you want to talk about with regards to the portfolios? The models, sorry.
Yeah, well, we just sort of talked about a little bit about fixed income, but I would add that we did a little bit of buying over the last little while, given our view on interest rates out the curve. So we did some investment grade additions. For some people, we did some high yield additions, newer clients. In our high yield mandates, we added risk. Tactically, we really didn't do anything tactically. We still have some impactful trades. The energy trade as of this recording on August 4th at 11:45, oil is breaking down a little bit here. And that's certainly affecting some of our position, certainly our equity energy position in Baytex has certainly come off a little bit here. We still like the macro theme on fossil fuel energy risk going forward, but we may be in for a bit of a bumpy ride. And in our balance mandates, as you mentioned earlier, Scott, our energy exposure is really through some bonds that we have. So they are much less volatile and pick out a pretty good yield for us, or interest income.
Great, thank you. And again, a reminder, we're always around. We want to review your circumstances, your risk appetite. We want to review your portfolio performance, your wealth forecasts, anytime that you want. We are here and ready to do that. So please get in touch, and we'll happily update anything that needs to be updated for your specific portfolio. And that's it for August. So enjoy the rest of the summer. And on behalf of Paul and Diane, I wish you all the best going forward. We will be back again at the beginning of September.